Hi everyone, this is Michael Bengiat from Lifetime Investor, and this is the Stock Picks Weekend Review video for August 27th, 2022. Before we start, here's our disclaimer. You can pause the video and read this. Okay, as usual, we're gonna go through the current market environment, and then we're gonna talk about the stock. Well, we only have one stock left in our portfolio, and then we'll go through the watch and ready list. At this point, too, there's really no stocks on the ready list. So the whole situation is deteriorating a bit, which leads us now to just talk about the environment. So we're still in a yellow environment, sort of caution, which we're just on the edge of going to red, which means it's really inhospitable environment, really should be just out. We've dropped our recommended stock exposure down to 15%. And for a while now, it's the best strategy has just been to swing trade. We're getting just really short pops, sometimes just one day to 2, 3, 4 days, sometimes 5. Really just not a lot going on. And it's mostly retail buying this, pushing stocks up into buy zones. And without the institutional investors stepping up and adding to positions, most of the breakouts don't last. And they fall back, or they're getting gap downs on earnings. All those things that have been going on for a while. So that's where we are. And we had a big plunge on Friday, which just kind of made the situation worse. Fed Chairman Powell didn't give Wall Street what it wanted to hear. And basically he said we're going to be hiking interest rates longer than expected. And we won't stop until we're really breaking the back of inflation, and the market didn't want to hear that, and we took a big plunge. But we already had a tip-off because we just haven't seen individual stocks working very well for a long time, and that's really the key if you're a stock investor, not an index investor. We just saw a lot of anemic breakouts, as we talked about, with no follow-through, and that kind of tipped us off what was going to happen. And it was for pretty much this whole year so far, we've been just very lightly invested. We've only been getting invested when the market is kind of telling us to. None of it's lasted very long. But again, we're in a bear market. Now, the good news, though, is that it's investing in the bear market is difficult. There are always stocks that are going up and going counter to the overall trend. But in this environment, in this particular case, not a lot of it's really working well. And the stocks that tend to go up have been the ones that have been the most beaten down. They're really in downtrends, or they're just shooting up out of V-shaped patterns. Just a lot of activity and action that's really not the healthiest, and not situations where we can really make any money at. So, but the good news is that the bear market will end one day. We don't know when, but there'll be a fantastic trading opportunity when that happens. And it'll be probably when nobody wants anything to do with the stock market. They're just all been beaten up over how much time it takes. And because we're already quite a bit into it. Remember, 2021 was a stealth bear market in the NASDAQ. So for a lot of stocks, we're over a year to a year and a half into a correction. And so I think when now all that goes away, all this extreme bullishness, we're still seeing meme stocks going up. That all will probably be gone, long gone, when the true bottom comes. So, but let's go ahead now and just go to take a look at individual stocks. So let's go to the first one. Actually, we're here on Humana. We just got stopped out of Humana. This was one we actually, this was almost like a record for this year. We owned the stock for 50 days. But we bought it coming out of here. It just really wasn't doing much you can see this is the buy zone here. It broke out into it, and you can see we had a fail. We came back up, failed again. We got to the top, and then we kind of broke down. So what we had done, since our initial risk was 4%, I think it was, we actually ended up moving our stop up to a little better than break even, and we ended up getting stopped out on this plunge here below the 21-day. And we took a little profit. We only had, I think, a quarter position or even a half position because the market's just not telling us to do anything other than small positions. So we made a little money on this trade, and this was in our long-term outperformer portfolio, and there's actually no other stocks in that portfolio at this point. But that's what happens. The fact that it broke this, it's wasn't on high volume, but I would say it looks like the stock wants to test its 50-day, which is this red line here. But it just really just was not performing, just wasn't really going anywhere. And that's another one of the things we put into the picture. How are stocks doing if they break out, and even if they don't fail? And many stocks are just doing nothing. They're just kind of floating around. So that's that one. Let's look at the other one in our regular portfolio, and that's Royalty Pharma. Now this one, we actually have our stop. We've moved it up a little bit, and we're right below this low here. This is, you can see it says 42.17. We're at 42.11. And our stop's about 4.25%. So that's acceptable. And again, you can just kind of see we bought it coming out into this little handle, just really hasn't done anything. And we're starting to see the relative strength drop a little bit, especially versus the S&P, which is this black line. So you can see we're starting to underperform the S&P, though of course this was the drop on Friday, yesterday, and we went up a little bit there. But we've come down, and now we're exactly at the 50-day moving average, which should hold. We're not very far away from our stop, so we're just going to leave it. We have a small position, so that's just what it is. So again, another one's just not acting well, and again, a reason why we really don't have a lot of positions on, because this is what overall this is what we're seeing, or the stocks are just stopping out. I'll give you another one. Here's one we were just watching, which is off our list now. Dollar. Down below the 200-day, that's this black line. Even Friday, even worse. This stock needs a lot of work now to repair itself, because it was just on all-time highs earlier this month. Okay, so let's go now to the stocks on our watched list, because we don't have any on the ready list. So let's go to Amylyx. That's how you say it. Yeah, Amylyx Pharmaceuticals. And the ticker is AMLX. So you can see this is a more recent IPO. And again, versus most IPOs look like this. They're just down, and then they're staying down. So this is a rare one that's actually going up. Now, it doesn't have any earnings, doesn't have any sales. So it's not making any money, and it's a small cap. So it's on the risky side, but we have a relative strength of 99. So it's outperforming basically almost all stocks in the market. And you can see it's formed a cup, and it looks like it's putting in a handle. Now, I think we tried this, or I tried it myself. I don't remember if on the service, but you can see these spikes just, that's what we're seeing a lot of, volatility. And when we come up here, we don't want the volatility. Like here, this was a nice little breakout here. It had kind of tightened up here, and when one final shakeout, and then we broke out. Unfortunately, we didn't get into this over here, but we're watching it here because we're kind of approaching the old highs. But we want to see it calm down here. We don't want to see more of this volatility. Now, this was on earnings, so it actually had gone up on earnings and then ended up closing at the bottom. So, but it's a small cap, and it's a biotech, so it's going to be a little volatile. But it's one of the better acting stocks. It's the only one we have on our list that's a relative strength rating of 99. So we're definitely watching this. But we do have some little resistance here around 29, 28 and a half. Let's see, that's 27. Yeah, from 27 to 29. It looks like these people here in March may be trying to get their money back. So there's some sellers that are floating around here. Ideally, this will kind of just come up close to this old high here and then tighten up on low volume. That would be even better. It means we've gotten rid of the sellers that were lurking here. In other words, we've come up here, but we're not getting any selling, pushing it down, and then a breakout from there. So that's what we're going to be kind of watching for. Let's take a look at the next one. Parsons, ticker's PSN. They do work in the defense and intelligence areas. So again, this one's just coming up, but a little bit of volatility. Now it broke out, then we had a big sort of plunge on earnings, but it's managed to come back. And you can see we're kind of tightening up here, which is what we're looking for. And the volume's coming down. So in other words, when this was back up at 43.80, 43.70 or 60, we started getting sellers kind of pushing it down, but we're getting to the point now where the sellers are not really pushing it down much. So we'll see how if this tightens up. Ideally a little higher, maybe around 43 would even be better, and then we get a breakout from there. Let's take a look at the weekly on this too. It's a little bit of a choppy trader. Let's look at the monthly. Oh, okay, it's actually an IPO from 2019. Interesting. That's something we like. Some of the best winners are stocks that have come out in the last 10 years. So this could be a nice winner going forward. It's forming like a big cup and kind of a high handle here. So that's a good sign. And the earnings are now coming positive again. That's a good sign. Overall ratings are not bad. And earnings are just kind of creeping up. Nothing thrilling about that. We're not really even getting a lot of mutual fund ownership that's really increasing. But it's looking pretty good. For whatever reason, it's one of the few stocks that's, making close to making new highs, where the 2/3 of the market is actually below its 200-day moving average. So we're down here. So it's one of the better performing stocks. So that's why we're keeping an eye on it. The next one is T-Mobile. Its ticker is TMUS. This one looked like it was about to break out, and then it really got knocked down on Friday's rally. But it's looking pretty good. I mean, it did break out of this. First, it had this big cup with handle, and then it formed a base on top of that. We call it a base on a base. In other words, it just went up a little bit, but then formed another base. And then we've kind of broken out on earnings. It's actually looking pretty good. We don't like this. We don't want to see this more volatility, especially on sell-off on high volume. So we'll see how this performs in the next week or so. And if it can actually maybe tighten up here, we'll see if we can find a place to get in. Next one is Costco, big cap. Ticker is COST. Now this one you can see is forming a pretty nice cup with handle, but a little bit on the faulty side. You can see here the cup would have been a little better looking if it come up a little bit higher and then formed over here. So it's a little bit of a low handle. We'll give that a black mark for that. And you can see we did kind of break out of this handle too, and it just got pulled back down. So could be that it's not really ready. This handle maybe needs to be a bit bigger, or something else is going to form here. It just wasn't ready. This sometimes happens when the structure is not sound and it's got some faulty aspects to it. It just doesn't really work. So, and we're coming back down here to the 50-day, and the 50 days is the red line, and the 200-day, which is the black line. Other negative of this too, because the stock's been kind of vacillating around, the 50 is still below the 200. We don't like to see that. Most leading stocks, you're going to see the 50 above the 150, which we don't show in this chart, and that's above the 200. And ideally, they've all been above there for at least 3 months. So we're already in a really nice strong uptrend. The best performing stocks have started when they're already lined up in that manner. So this one's not quite there. So, but you can see it's not doing nothing wrong. It's close to its all-time highs. So we'll continue to watch that one. Next one is Amdocs. Ticker is DOX. Now this one's been interesting. It was one of the few software companies that's been actually was making new highs, though it seems like it's run a little bit of trouble recently, and it's been volatile. We don't like all this volatility, up here, down. It kind of tightened up. You can see it tightened up over here and tried to break out. It's a little too volatile, so that's why we're watching it. But it is one of the leaders, and it seems like the earnings are growing nicely over time. Overall 89 rating out of 99. So it looks not bad. And it's getting up towards large cap status. And again, it's one of these companies that a lot of people never even heard of, which is sometimes nice. Is when they're unknown, that's when sometimes you can get nice big moves because there's not tons of eyes and people already investing in it. So sometimes these ones are stealth performers. I'll give you an example. A good one was Copart. No one really had ever heard of Copart. It actually took a big dive, but if we go back to a monthly chart, you can see starting in 2016, this thing was a really nice performer. It went up from 20 up to 140, and it's really off most people's radar. They deal with car auctions and things. I think So, and it was just off people's radar, but it was a really nice performer. Unfortunately, just like most growth stocks, got hit hard during the stealth bear market, which was over here. And then this is now in the bear market that the market's in. All right, let's go back to our list, and we have Dollar General. This one too, it's gotten a little volatile. Partly this plunge was because of Dollar Tree, which had sort of had an earnings miss. This wasn't as bad, but now we're coming down. So this may be coming off our list. It's well below now the 50, but we'll give it the benefit of the doubt for a few more days. And then the final one is AstraZeneca. Again, it was looking much better until yesterday. Yesterday's kind of making the charts look a little extra volatile. This one, it's an ADR. And so it's got a little bit of gappy, choppy action because it's trading just the ADR shares here in the U.S. And it's a little bit of an odder pattern. We had a double bottom that kind of tried to break out, and now it's kind of going to a flat base. It's got an RS of 87. It's not our favorite stock, but there's just not a lot of things going on at this point. So anyways, we'll keep watching it. If it tightens up here and it can break out, it could be turned into a nice winner. Let's go into the weekly. So far it doesn't really show a nice history of making a big move too, but you never know. Sometimes they consolidate for a number of years and then they take off. Actually, the monthly chart's not bad. It's not a huge performer, but it does have a nice trending aspect to it. So we'll keep it on the list. Okay, we have just two more in the long-term outperformer watch list. The first one is Cadence Design Systems. Now, this has been a fantastic performer over time. Let's look at the monthly chart, and you can see this is just the kind of thing you love to see. And this is what we look for our long-term outperformer stocks. So we actually had put in an order a couple days ago, I think it was Thursday, to buy it if it was going to break above this high here. In other words, we sort of broke out of this cup and then it just failed, which is okay. Sometimes they come back down to the top of the breakout. And then we have what's called a pullback. So in other words, it comes back here and then starts to make a pullback up there. So we had an order, I think it was somewhere around there, 185.50, I think it was. It never got up there, so we were never filled because we only do these orders, buy stop orders on a day basis. So it never got filled, and then we had a big plunge on Friday, so it's just as well we weren't filled. But that's why we use those kinds of orders, and we also put them in places where if it does break above these last couple days, the odds are it's going to continue higher. So this one's, we're going to keep it on the list because it is a fantastic performer, growing nicely, and it's great, all in all, great ratings in terms of earnings, sales, margins, all that growth rate. It's a large cap, $48 billion stock. And but this was a kind of on high volume. We'll see what happens. Maybe will just turn into a one-day blip, or it could be that we're going back into a bigger correction. And the next one is actually Costco, which we discovered. So that's really it. Not a lot of things really set up. Nothing on the ready list. What stocks that were on there went back into the watch list. So we're just back in watch and see mode. If the market just plunges and falls apart, we really don't have much much skin in the game, except for Royalty Pharma, which we're pretty close to the stop. So even if we get stopped out of that, it's no big deal. But that's it. So we'll be back next week. Maybe we'll have more interesting setups and situations, but this is what we're handed, and we try to just make the most of it. And if there's nothing going on, we just don't do anything, because we're in this to make money, not for excitement or action or trading for trading's sake. We're in it to make money. And of course, as we've mentioned all year long, it's a very difficult environment. We are in a bear market, so you have to have patience. But this is how you learn. If you can do well, and doing well can mean that you just lose very little. In a brutal bear market, you are doing really fantastic. So, we've had a lot of stocks stop out. I think we're down 7% overall in our main portfolio, while the market was down 20%. So, it's pretty good. I mean, if we had taken profits a little quicker, On some of the earlier trades, we've probably only been down like 4 or 5%, but that's not bad. We're not double digits. It's acceptable. Of course, we'd like to be positive, but we're navigating a pretty brutal bear market, and just doing our best to not get into trouble and to position ourselves when the time comes to have our cash available and ready. Because when a new bull market starts, there's going to be really good money made very quickly. You'll see breakouts happening, and they will just take off, and there'll be a lot of them. So we're not there yet, but that time will come. So we just continue to watch and see what the market does each day. Okay, we'll be back next week with another video.